how about Silicon Valley? How far behind the demand, the number of people, the population growth in Silicon Valley vis-a-vis, to the construction growth in Silicon Valley?
Very little land less. Next time you're at that 10,000 foot view that I keep talking about, look
Right.
down. You see a lot of bare land across the most of the United States. You look at the Bay Area, we're jam-packed. We have to move up, not out, right?
Oh,
so when
go
you
down.
look like when you look at San Jose, look how many high-rises, look how many cranes there are in downtown San Jose building high-rises for condominiums and such, right? So we're out of land. So I don't think we could ever keep up.
Hi there, thank you for coming to our very, very special episode today. We have Dave Campagna. I said that right, I hope. And it's a very special day because it's Dave's 33rd birthday as a mortgage broker. But since he's got so many years in Silicon Valley, as far as seeing how Silicon Valley basically grew from a farmland into what it is today, he knows a lot about real estate. But we're going to stick to basically asking him about where prices are, why is it, going up so much? Why is it, a whole bunch of really fun questions. And Dave also have a little short presentation for us about where Silicon Valley's prices are and how it's been performing over at least the past year or so, and give us an inside scoop onto where this real estate market is headed to. Dave, welcome to the show. Thank you for joining us.
Thank you, Charlie. It's a pleasure to be with you here today. And I'm so excited to share this information with everybody. And, as I like to start off, me being a lender, I kind of have, imagine you're in an airplane. I have the 10,000 foot view. So while I'm looking at statistical information, Charlie's really your go-to in regards to, it's down to this one house. This is the one I like. Charlie, am I spending enough or not enough or too much on this place? Or should I wait? Should I buy now? So we'll go into all of those topics, but keep in mind, I got the 10,000 foot view. So with that, do you want me to go ahead and jump on into what's going on?
We're a team, Dave. We're a team. So
absolutely.
Yeah, we can't help but climb closer a deal unless you're giving a whole bunch of ammunition and firepower for us to go get those deals done, especially in today's market where a lot of deals come in with 10, 15, 20, 30, 40 different bits. So you're the money guy. You're the guy that we have to be nice to or say, please give me the ammunition and go out there and so I can win this one. Right?
Absolutely. We want to put people in the best position, and knowledge is power. So hopefully we can share some great knowledge with you today to show you where the market is and where it's headed towards and what it's done in the past, so you can formulate if it's right for you and for your family.
In 33 years, you've seen Silicon Valley transform from what it was before into what it is today. Can you share maybe one really specific story about the last 33 years that would be fun to know? I mean, what was the funnest thing that happened to you in the past 33 years in this business?
It goes without saying how many people would go back and say, oh my gosh, if I knew what I knew yesterday, right, I'd be a millionaire, right? I was just talking to someone the other day. They were buying outside of Silicon Valley because they felt like they were being priced out. And they're like, oh, these prices, they can't stay the same. But I hear that story all the time. It's just the numbers keep changing, right? They keep going higher and higher. Oh, there's no way that's going to cost $1 million. Now we're pushing up over $2 million, right? And so the key thing is that when it comes to real estate, buying and holding is always the best pattern. Long term is the best pattern. And as I always like to say, you got to live somewhere, so you might as well have that money working for you and make it your own place. So, I think the biggest thing in the transformation is remember when you can buy this neighborhood for X amount and now it's X amount more, right? If I knew that, I should have bought two, right? That kind of thing.
The best time to buy real estate was always, is always almost always yesterday.
Right.
It's never, yeah. The news that came out, one of the biggest news that came out in Silicon Valley today here is this fresh from news, Nvidia released their results today, and it beat all market expectations. And before it closed today, it was down by about 2%, and then after markets, it's now up almost 8%. It's like wow. So that tells us a whole different story about another number that we saw also, that last year Silicon Valley lost 240,000 jobs. So these are just numbers, statistics that, it's just FYI. I will not hold you back. Dave, please do your thing. Share with us what you've, your slides. I'm very excited to see them.
Yeah, no problem. I always like to use visuals. I've been told with the 33 years of being in the sales industry of lending money that 85% of the population learns information visually. So let's get you some visuals to start with. So as I start to share screen right here, I'm going to start with the San Jose area, right? So in San Jose, I'm going to spread out and just look at the single family homes all by themselves, and then we're going to move into the condo and PUD market because I wanted to show some contrast between the two. And I have the advantage of being able to pull this information very, very quickly. So I'm going to bring you January's numbers as they come up here on the screen. And, most national numbers are 60 to 90 days behind. So you're always looking at really old news when you're just watching financial channels or on the internet and things like that. Is that a lot of times the numbers, they're still probably bringing you November and December numbers when we're already giving you January numbers, and we're 3 weeks into February already. So how you read this on the screen in the purple there, we're seeing that in January there were 320 sales of single family homes. Now, I say this is the greater San Jose area, and let me redefine that. It's not all of Santa Clara County. If anybody's curious about all of Santa Clara County, definitely get a hold of Charlie. We can get you numbers specifically for the areas that you're looking for. But in general, people kind of buy in certain areas, and not all people buy in the same area, right? Because different price points, different demographics for different incomes, depending upon where you're looking. So this is going from all the way to the south end of the county, which is Gilroy, San Martin, and Morgan Hill area, all the way through to Cupertino, but doesn't go on up the peninsula a little bit further, still Santa Clara County. Now, we did break out San Mateo County. That'll be coming up shortly, but just to understand why, somebody who's looking in, say, Palo Alto, Menlo Park, Los Alto Hills, is not the same buyer who's looking in Los Gatos, San Jose, or even down to Morgan Hill, Gilroy, right? The demographics are different. And so we didn't want to lump everything together, because then you have just really extreme numbers, and it's a little bit harder for everybody to comprehend. So as you see on the screen, the average listed price in the month of January was $1,826,000. The DOM, it's not Dom, it's not my nephew whose name's Dominic, it's days on market. So the days on market took 24 days. Now that's from when that sign went out in the yard, right, and became active on the computer or the multiple listing service, to when they accepted an offer from a buyer. Not from when it closed, but from when they accept the offer. Because at that point in time, they've stopped collecting new offers, right, because they picked one. So the close price is what we can now disclose because it's already happened. This is factual data. It's not a guess, right? And so they sold a little bit higher than the asking price in this greater San Jose area at $1,866. And so that you know what the average home is, it's a 1,900 square foot home on quite a larger slice yacht at 12,000 square foot lot. Now, a lot of times people go, why is it so much? Well, sometimes people in the south end of the county, they might buy a full acre, which is going to skew the numbers, right? Full acre is over 44,000 square feet, right? So settling down at 12, it's typical to see someone that's 5, 6, 7,000 in lot size, right? And then we divide the price per square foot. Now, we don't simply take the close price divided by 1909. It averages each one of those 320 sales to come up with that, just so you know the math. So how are we doing? I don't know. We have to compare it against something. So we're going to compare year over year. So to start with, we have the January 2024 numbers. Here's the January 2023 numbers. And as you can see, that the numbers are much greater. And let me go ahead and do the math for you. Since I am the numbers guy, let's bring up the next one here so that you can see it, right? Obviously, our list price, or what we were hoping to get, went up 3% when we were listed at 1826 this year. We were expecting last year to get 1778. So we've bumped up in price 47,000 as far as sellers' expectations. Now, the actual close price was $119,000 or 7% more, or as I like to say, 119,926 reasons why you should buy a house today. We led in the intro about, hey, what are some of the things that you remember over the last 30 plus years of doing this business? It's wow, if I knew today what I knew then, I would have bought 2 houses, not just one, right? So as you can see, lots of reasons why. I know 1 year doesn't make a market, but it definitely shows you where our trend is. Speaking of trends, let me bring up a couple of things. We did talk about list price versus close price, and on average, we're getting 102.2% of asking, or 2.2% more than what the seller had originally listed the home for. And that's on average. So again, you're going to need Charlie decide on what to offer on a particular place, depending on how many offers are coming in. Sometimes the seller prices it too high, sometimes they price it too low, and sometimes, just like those 3 little bears, they price it just right? But on average, they're pricing it and fetching 2.2% of asking because there's a lot of demand. Now, we'll go further into the demand and supply numbers when we get to our national numbers. One other thing I wanted you to notice is that the amount of sales, our sales are going gangbusters in the San Jose area, even with low inventory. We had a 15% increase of the number of units sold. Now, I promised that I'd show you the condo market, right? The PUD or townhouse and condos. And the reason why I wanted to do that is I wanted to make sure a much broader audience can view things, because not everybody can afford a $1.8 million place, right? So let's look at and segment this out. And here's what we did for that marketplace, for the condos and the PUDs. As you can see, it's the exact same categories, right? With days on market, list price, close price, everything else. We had 136 sales. And again, until we have something to compare it to, really doesn't mean a lot, right? So let's bring up the January of 23 numbers. And as you can see, we did sell more homes this year versus last year. And we did so for more money, but not at the same pace. Only a 1% increase. But wow. I want to mention all the way on the bottom right-hand side that our price per square foot, well, that went up 3%. So, statistics can be bent one way or the other, right? And if we look at our total square foot of being 1312 in January of 2013, 2024, we sold smaller homes. So smaller homes tend to go for less money, right? So you do have to pay attention to everything on the screen, in my opinion, because we're seeing $18 per square foot more in this other category. Now, I know that not everybody wants to live in San Jose. In fact, myself, I grew up the peninsula in Burlingame in San Mateo County. Oh, but before I flip the screen, we did get 101% of asking, and obviously we had a 17% increase in the amount of sales that we did. Now let's switch to San Mateo County and see what's going on there. Like I was saying, I grew up personally in San Mateo County in Burlingame, so I've seen a lot of change. And you talk about that change. I remember helping a real estate agent at an open house and seeing a house that was available for sale, and you're hearing me chuckle already because it was for sale for under $400,000. That house today is worth over $2 million. Wow! So I've seen things change quite a lot. The tail in San Mateo County, as far as the list versus close price, is a little bit different. They're not quite fetching the full percentage of asking, and they're staying on the market just a little bit longer. But it's also a smaller marketplace. There's over 2 million people that live in Santa Clara County, and in San Mateo County, those numbers are much smaller, right? So there are less availability opportunities. So you'll see a little bit more fluctuation because, as you can see, there was only 143 sales as comparison to Santa Clara County, which wasn't even the whole county, right? Was up over 300 300 sales. So a lot more sample data to go from. Let's bring up the January of 2023 numbers so you can see the dramatic price change is the big takeaway on this one, because a lot of things stayed pretty close to the same as we bring up the math. The math here, oh my gosh, up 18% or 402,481 reasons why you should probably buy real estate. Now again, this is single family only, so at 18% in 1 year. And that goes to our lack of inventory out there. There's just not a lot of selection out there. So you got multiple people bidding on the same place, and that drives the price up. Now you'll notice that the opposite happened on this slide, where we're seeing that our price per square foot is up 10%, right, or $101, because you'll see that it was a slightly larger home in 2024 versus 2023 when we look at 2174 square feet versus 1938 square feet. As a reminder, Charlie's always here to help you decide what to offer on the individual home. I have the 10,000 foot view of all 143 sales this year. Wow. He's going to narrow it down to the one that you're going to call home. So lean on him for where you should be making an offer on a piece of property, or if you're looking to sell, what you should market it for and what you should start off with as a list price, because he's the expert down to the individual home. Charlie, you got more to add to that?
Well, thanks for the advertisement. I really appreciate it. There is a huge difference between the days on the market. Almost one, on the greater San Jose is 23 days. This one's at 41. So is there a reason why? I mean, it's gone up a lot more. So would you not expect?
Well, it's only increased by 1 day, so it's exactly the same as it was. Oh. Now, I will say that we wanted to get you the most recent information, but if you go back 41 days on market for a sale in January, that puts you in the middle of the holidays, right? When you're making that offer, because that's not when it closed. That's when the offer was accepted. So, it sat on the market from somewhere between late November to mid-December. And, there's just not a lot of activity during those holidays. It's cold. It's dark out sooner. So not a lot of activity happens. As we move into spring, you'll probably see those days on market shrink a lot. But it's good to know where your baseline is. And, every month's going to be a little bit different. In fact, I've got more on that in just a little bit.
Dave, I was comparing San Mateo County to the greater San Jose. The number of days on the market you showed on the earlier slide was 23 versus 41 right now. So is there a reason why greater San Jose sells a lot faster than San Mateo?
Well, let's remember one thing. Our average price point was almost $2.6 million here, right? So it's a much bigger purchase, right? And it might be a move-up buyer that's buying that house on average versus a first-time buyer. Not that 1.8 is exactly affordable, right? But that's the average price in what we had for San Jose. So there's some people that are at 1.1 to 1.5. Or maybe even all the way to 1.8. And let's talk about, since I am a finance guy, let's talk about if you were a first-time buyer, like you're not selling a place. A lot of people that are buying at this price point, no doubt, are probably involved in the tech industry. So they may have restricted stock units or 401k funds that they can use for down payment. But let's face it, it takes a lot of money to be able to buy almost a $2.6 million house. Odds are they're a move-up buyer. So, things take a little bit longer because they have to sell their house before they're buying the next one. So that might influence it a little bit more. Whereas a first-time buyer is just moving out of a rental. And then let's also talk about the minimum down payments. To buy a $2.6 million house, you generally need 20% down. To buy a $1.8 million house, you only need 10% down. To buy a $1.2 million home, you only need 5% down. And as you start going a little bit lower, you might only need 3% down. So the threshold for moving in happens a lot faster. So that might be why these things sit a little bit longer, because it takes a more unique buyer, right? Somebody who's moving up in price range, most likely. I don't want to discriminate. I'm just trying to use the law of averages.
That makes sense.
So, finishing up the slide just to kind of show you some of the percentages. When we're looking at the percentage of asking, you're getting slightly below asking price. So maybe they were a little zealous on what their list price was, but I'm sure they're happy that it sold for almost 2.6 million, as most people in California hold on to their homes for 7 to 10 years. And I don't have to tell you that over the last 7 to 10 years, it's gone up a lot. As far as the number of sales, you'll see that those are on the decline, but only about 11%, not much of a differential. So does that mean that home prices are going down? No, it clearly shows that the home price is very, very healthy. And, not just in these two geographical areas. I want to go into some national statistics as well, because there's a lot of news out there and a lot of people get confused by some of the headlines. So do you mind, Charlie, if we switch gears to the national scene?
Please go for it.
Okay, cool. So when we look at the national scene, there's lots of different agencies that are sending out information. And I know some of these just look like a bunch of alphabet, right? But Case-Shiller, they're reporting. They're kind of known as the gold standard. As you can see, the December numbers are missing for a couple of those people, but a couple have reported already for the entire year of 2023. So as I say, it's a treat to have that super hyper local information versus this nationwide, or sometimes you'll get stuff from just the state of California. But it's nice just to see where things are trending in general. And as you can see, it's about 5 to 6% is what about the national amount of appreciation of homes on a nationwide basis. But that's why you hear different numbers in the news, because as a consumer, you may not pay attention to who's reporting it. You just hear the number and think it applies to you, right? Well, that's why you need Charlie again to get hyper local down to the house or the handful of homes that you may be looking at, and he can help you with a price strategy, whether you're selling or buying it, but trying to give you national trends. Now, I hear it all the time. Hey, Dave, I'm going to wait to buy till the house market starts to crash and go down like it did in '08. And that's the only time in history where we really saw that big of a recession affect housing. And in fact, most recession housing prices go up. But I want to get you some additional information that's out there that people just kind of don't put two and two together, that leads to why real estate is going to continue to be a great investment. And it has to do with that supply and demand. So let's dig down a little bit deeper on supply and demand outside of the local market and stay national. So to start with, when we look at the kind of solid line going straight up there, not straight up, but at an angle, right? That line is our U.S. population and where it's predicted to be in the future. We're sitting at 335 million, right, in U.S. population. And the squiggly lines, they're showing you what our existing home inventory is for homes nationwide, about 1 million homes available for sale nationwide. So talk to you a little bit about the dotted line. So the dotted line was that '08 Great Recession is what they call it, right? Where we saw housing price dip. So as you can see, inventories pending or inventory going up to that point kept rising from about 2005 through 2008, and we just had a lot of inventory. And we didn't have enough population to keep up with it. And you'll notice like 11 or 12 is when they intersect, where our inventory kept shrinking, but our population kept growing. And, it's not all about just selling houses, because as we have new babies born, they need to live somewhere, right? As we have people growing up, going to college, getting their first job, they need to live somewhere too. And our elderly community, they're living even longer. So we have to build more houses. Well, the one thing they're not building is more land, right? So we do have a challenge with that. But even further than that, I'm going to bring up another slide which talks about household formations. And what's a household formation before I turn the page? So if I live with mom and dad, or I live in my apartment, and then all of a sudden I'm going to cohabitate with somebody, and maybe I'm going to start a family. Now that's a household formation. I move out of mom and dad's place and I move into my own place, right? Or I had roommates and now I'm going to form my own household formation. So the population's rising, but is everybody living together? Well, some do, because some areas are more affordable than others. But let me just share with you, when we go back to this '05 through '08, or even 2011 and 12, on what was happening for formations versus how many homes were they building, and why did everything crash, besides the obvious of, we had subprime lending products, right? So let me show it to you in a little bit different perspective. So these orange lines are the completions. These are how many houses that were built. And as you see, leading up to 2008, the builders, they just kept building. And we didn't have enough household formations to buy them all. So what happened is that you had this large amount of inventory. And again, I've said it more than once, is that supply and demand took over. You had too much supply, not enough demand by household formations, and you kept building a lot of houses. Well, it's no doubt that housing prices went down, because the other thing that happened along with this is as prices started to fall and things started to domino, in '08, people would lose a house through foreclosure or do a short sale, which meant they became a renter for the next foreseeable future. So they weren't even available as a buyer. Whereas today, every time I sell a house, unless I died, I'm going to live somewhere else. I'm not going to be living in a tent, right? I'm going to go live somewhere else. So it's going to be a swap of inventory. But if those formations keep growing and we're not building any houses, we're going to have some challenges. So as you can see, they've had some completions. They're growing, but it is nowhere near keeping up with the formations. And the formations are outpacing the completions. So that tells you why real estate's still going to be a great investment, because we don't have enough places to house all these people. And that is going to be the supply and the demand that is going to continue to raise prices. Again, I'm the 10,000 foot view. Talk to Charlie. He's going to tell you about the 5 you like as a buyer, or your individual home that you're trying to sell. He's the pro at getting down to the local level, right?
Thank you, Dave.
One more thing I want to share, and then I'm going to turn it back over to you, Charlie, is seasonality with the time of the year. Now, we just had Valentine's Day. We also just had Super Bowl, as we're sitting in mid-February of 2024 when we're recording this. And a lot of people who've been in the real estate business for a long time, pick me, know that the heaviest selling season is in between Super Bowl Sunday and Mother's Day. That's when we see the majority of our activity. And it's not just me telling you that. I've got the next slide that's going to prove my point, thanks to the friends at Case-Shiller. Now, we're here in the Bay Area, so let me bring you this, but this is national numbers. And it is a 49-year average. And I said Super Bowl Sunday, and those poor 49ers, they played a hard game, but they just couldn't win. Damn. But, you know, this information was from 1973 by Case-Shiller when they started collecting it. And what you're looking at here is that you're looking at the numbers going up, right? So as we see these numbers going up, that is the month-over-month change on real estate prices. Then you see it going down here. Does that mean prices are going down? They're not. They're just not going up as fast. And again, this was from 1973 to 2022 of this data being collected. So if you are looking to do something, you definitely would want to get in sooner rather than later, because you're about to miss out on the appreciation in March, April, and May, which is the biggest amount all year. We had talked about nationwide, we're 5 to 6% gain. Well, it doesn't do it exactly even for every single month. There are slower months and there are faster months. We talked about the days on market for January. Look at January and December's numbers. It only has a 0.12 gain, and that is only second seat to November of the lowest change from November to December of from October to November of 0.1. We're getting into the most fruitful months, so you'd want to be ahead of those and get into real estate now. And again, as a comparison, if you're going down the freeway and you're breaking the law, you're speeding, you're going 100 miles an hour, that's deciding what the you're on 280 and your speed limit's 65, you're going to go a little bit faster if you're late to the date or you're going to work or whatever it may be. That's March, April, and May. All of a sudden you see a cop ahead, you take your foot off the gas pedal a little bit, but you're still going the speed limit. You're still going 65, 70, you're just not going to get pulled over. That's the analogy. So when we're looking at it going down in June through December, it's not going down, it's just not going up as fast. So that's what this chart's trying to demonstrate. Cool. And I know a lot of people, if they're watching financial news, go, Dave, I want to wait because interest rates are going to get a lot better. The Fed's not going to keep interest rates so high for so long. So my next slide is going to talk about that. And that's compounded with this one. Because remember, when you buy a house, most people get a 30-year fixed rate mortgage. So we have a little saying in the industry, especially if you're a renter. It can be three parts, right? You want to marry the new house, but you only want to date the rate. You may want to just rent the rate, right? So you're only going to keep that loan for a short period of time, but you want to get in ahead of this appreciation. So you can always refinance 6 months down the line, a year down the line, whenever we start to see the economy not having inflation being so high and the Fed lowering things. Now, there are constantly new reports that are coming out and different things that come out that will affect whether or not the Fed will lower and when they meet. Now, most people don't know that they meet every 6 weeks, so I'm going to bring up a chart to show you when the next meetings are in the next 1 year's time. So this chart that we're looking at right here is showing you when the meeting dates are. So as you can see, our next time that they're meeting is in March 20th to be exact. Now, what are all these numbers here across the top? What are these big high numbers? Well, they're really not that big. It's just because they talk in financial terms, and so they use what they call basis points. So 1 basis point is 0.1% of 1%, right? So when we look at this, it says 525 to 550 all the way on the right-hand side. What that means is that the current rate that the Fed has it at is 5.25 to 550. And you go, well, which one is it? Is it 5.25 or is it 5.5? They always quote a range. And who gets to borrow at that rate? Well, us as consumers, we don't. It's what the banks get to borrow against the federal government. Well, if they're a bank, why would they need to borrow money? I'm sure you've heard of the FDIC insurance. Right. FDIC insurance says to the bank, you have to have so much in the bank at all times in case someone comes down to the bank and wants to pull their money out, right? And so they have to make sure they meet those limits. So this is the overnight lending rate between the federal government and the banks. And it's established what it's going to be, and it affects everything across the entire globe. But anyways, we're 5.25 to 5.5%. So when I'm reading this chart, we want to pay attention to the blue marks. And it said that in the March meeting, there's a 93% chance that they're going to leave everything alone, as you see on there. Then they meet again in May 1st. On May 1st, there's a 69% chance that they're going to leave rates alone. Now, this is all data dependent, as you'll hear our Fed chair always say, right? It's not until the June meeting, June 12th, that now the scale starts to be tipped a little bit, that they think that the Fed may lower interest rates 0.25% on June 12th. 53% chance that they will. There is a 40% chance that they'll do an additional 0.25% in either July or in September. So you can see the chart of the probabilities of when they're going to do things, more focusing on the fact that I said, hey, we're going to marry the house, we're going to date the rate. And when we start looking at July at 5.25 to 5.5%, we're looking at that the July numbers is only a 10% chance that they didn't lower it, right? That's the other way of reading this chart. And by November, there's only a 1% chance that they're going to remain exactly where they're at today. Now, that's based on current data. So we're going to marry the house, we're going to date the rate, and when you guessed it, we're going to divorce our landlord. So that's why you don't want to wait, is that you've seen the appreciation locally and nationally. You have seen what's going on with household formations. You have seen what's happening with what's going on with interest rates. So hopefully this gives you a more rounded view of everything that's going on and why As you started, you said, "Hey, Dave, what have you seen? Hey, I'll take 2 at that price." Right?
That's
Because
true. So here's a $64 million question. What happens when interest rates comes down to all of us? Will we see more activity in the real estate market?
100% true. Along with
And
that Super Bowl, the Mother's Day phenomenon,
right,
as we start to see interest rates go down, which may not come in time for that. I mean, they say May 1st is the meeting that maybe we might see something, but it's looking more like June when everybody goes on vacation because the kids are out of school. But once those rates start to go down, yes, you're going to have all the people say, "Hey, let's get off the sidelines," and probably more so of the move-up buyer. So probably more important on the higher end of the market, so that San Mateo County or the higher price points in Santa Clara County, because they're selling something to buy something and they may not want to give up their interest rate. But remember, somebody is always selling, and that's what people forget. Oh, no one's going to sell because their rate's so great. Well, people get divorced, people die, and people have babies. And people have people that move out of their house too. So your household size might change for many different reasons, which would cause somebody to sell. I mean, I don't think there's any divorce attorneys that say, "Hey, let's put off the divorce and till interest rates go down. It's okay. You can move your new girlfriend or boyfriend into the house." No one's doing that. So there's always a need to sell. So it's just that you'll probably see more people transact. And as I said, as you sell, you're going to buy something else. And those first-time buyers that were saying, "Hey, it's unaffordable," it just becomes more affordable. But the smart people will buy now, and they'll marry the house and date the rate.
Nice. Very interesting question for this particular year alone. In November, we'll see the presidential elections. I'm not going to ask you which side you're on, so this is not the platform for that. But my question here is will interest rates, traditionally see, it coming down before a presidential elections? How will, is there going to be an effect onto the housing market in general?
That's a great question. It gets asked every 4 years, obviously. and
you got 33 years over there.
Textbook, the president can't influence Jerome Powell, who's the Fed chair, on whether they're going to lower rates or not. Like, he's not part of those meetings.
No, he's not.
So from a technical point of view, the president has no say. And it should be those Fed members that are basing it based on the economy. Now, I will say one president versus a different president, whether they're an incumbent or somebody running for office, may have a different philosophy on trade or on jobs and different things that could affect the economy, which could either slow or speed up the economy, which would have an impact on interest rates. But it's not like if X candidate is now the president, they say, "We're lowering interest rates." They don't control it. So I know a lot of people believe that that's going to happen. And, I did see some of that effect when you've seen changes in the past. I won't go into politics, but I did see some activity one way or another over the years of doing this every 4, right? Of doing this is that, this president is pro whatever, which may be good for the economy, which means that we'll see more activity because interest rates are going to go up because of this economy. Or versus the opposite of the economy is going to crash. So interest rates are going to go down when the economy crashes, right? To spur it on, they lower interest rates. So the direct question, it's so convoluted and really hard to guess. I'm going to leave it to the people in Vegas to run the odds on that one.
It's not an easy question. That's why I thought it would be fun for you to answer.
Right. From a textbook point of view, it's really hard to answer because they really don't control it, but they do control some outside influences.
Yeah, I was kind of hoping to get a 2 cents worth. One question I'd like to ask as well. So your numbers, the rise in real estate prices in Silicon Valley is between 5 to 6%, generally between the greater San Jose and San Mateo County. The inflation rate for the U.S. last year was just shy of 4%. So we're seeing the price of real estate just outpace the rise of inflation. Any thoughts on that. I
Yeah.
usually say
I got
that.
great thoughts on this, and this is a lovely subject. You're
Let,
going
let
to be
me
surprised
let
by
me
my
finish the
answer.
question first. Let me finish the question. My question, my argument has always been one of the best tracker of inflation, which is not a big problem, thing with everyone, is real estate because it tracks, real estate tracks inflation best among most, most, yeah, investment devices. Oh, what are your thoughts on it?
Well, to start with, what the Fed looks at is two different reports on really several, I should say. But the most popular is, in their Fed's favorite measure of inflation, is called the PCE, the Personal Consumption Expenditure.
Yes, yes.
That's their favorite measure, and their mandate is they want that to be under 2%. So they'll keep rates higher for longer till they reach that. Ask me how much real estate prices are part of that index.
How much are real estate prices part of that?
0.
You're kidding.
Rents
Why?
are part of it, but it
Oh,
doesn't have anything to do with housing prices at all whatsoever.
oh, why?
Housing prices are not part of that inflation index. Therefore, what happens to housing technically would not affect interest rates because it's not part of the inflationary component. But
Okay.
you had asked, how interest rates will affect housing prices, and they definitely will go up. And I had something, and now I lost my train of thought on the beginning part of your question, which now I can't remember the answer to.
If
It.
real estate is not going to be part of that part of that index,
Oh, I remember exactly what I was going to say.
okay,
You had
go
said,
for
hey,
it.
if inflation is going up this much and housing
Right.
goes up this much, should they be equal to? Is that an indicator? And I would say yes, only if you're paying all cash. And you go, why is it you're paying all cash? Well, when we
Why?
qualify somebody for a home loan, do we use 100% of their income to qualify or a percentage of it? We use a
Right.
percentage of it, obviously. Nationwide, we use about 25% of your pre-tax income as your housing debt. So that means 75% of it we're not using. So does your income have to go up the same percentage as the house price? No, it doesn't. It only needs to go up 25% to stay even with the housing prices. And
Wow.
everybody forgets about that because your income needs to be comparative to what the housing payment is. And unless you're paying 100% all cash, you're leveraging it. And depending upon your down payment, it's to your favor that the more you put down, the less of your income you're actually using. But from a pure qualifying standpoint, for every dollar that your house price goes up, you're only using 25 cents more income. So as you
Wow.
start compounding that, and you look at the first Friday of every month, we get the Bureau of Labor Statistics, abbreviated as BLS, we get their unemployment report. But part of that report that comes out from them is the average earnings across the United States as hourly, as well as amount of hours works or take home, home pay per week. And
Oh,
as long
wow.
as that number is keeping pace with inflation, then you should still be able to afford the home. The last time they did that, it was up 4.5%. I brought
Cool.
you inflation numbers for houses nationwide at 5 to 6%. And
Right.
again, if I only need to use 25%, well, then 4 times 4, using 25%, would mean
Right.
that the house price can go up 4 times that and still be even. But nobody wants to be even. They want to get ahead.
Wow. Very, very good argument. Thank you for sharing that. One thing about Silicon Valley real estate I want to ask you is you mentioned earlier about the growth of inventory coming in, nationwide. You had a graph for that. My question here is this: how about Silicon Valley? How far behind the demand, the number of people, the population growth in Silicon Valley vis-a-vis, to the construction growth in Silicon Valley? Is there?
We
It
have
doesn't
very
seem.
little land left.
It
We
doesn't
have
seem
very little land left. Next time you're at that 10,000 foot view that I keep talking about, look
right.
down. You see a lot of bare land across the most of the United States. You look at the Bay Area, we're jam-packed. We have to move up, not out, right?
Oh,
So when
go
you look
down.
like when you look at San Jose, look how many high-rises, look how many cranes there are in downtown San Jose building high-rises for condominiums and such, right? So we're out of land. So I don't think we could ever keep up. With COVID being well into the past now, we're 4 years almost out of COVID, right? We had our lockdowns right around St. Patrick's Day in
Right.
2020, which is coming on up. We're less than a month away from that. We're 4 years away from when COVID first hit, right?
Wow.
So now employers are starting to say, hey, we want you back, even if it's a hybrid schedule. So some people who did a mass exited from the Bay Area are going, maybe I'm not going to live in that other state anymore. Maybe I need to move back because I need to be in the office 1 or 2 days a week.
Right. And with the growth of, like information, like, the results of NVIDIA, where companies inside the Bay, in the Bay, is still growing at record pace, like, this. And I know that there's been a whole bunch of layoffs last year, but people in AI are still hiring like crazy. Sam Altman in San Francisco is still hiring like crazy, and so is Elon Musk on the East Bay. They're all still hiring. The population in Silicon Valley would continue to grow in a fairly aggressive way. Would you agree with that?
100%. And it's always funny when you see a big layoff and you hear the number of employees, but not the percentage of total workforce. Like, I don't remember what company it was, and I don't remember exactly when it was, but it was somewhere in the last couple of years. Somebody says, oh my gosh, they laid off X amount of people. And I'm like, yeah, that was 8% of the workforce. So
Right.
Let's say that in reverse. 92% of their employees are still working there.
What they don't tell you
It's a
about
really high percentage. If you're in school, that's what, a B plus to almost an A, right?
Right.
Like, you're still doing really good.
Well, what they also don't tell you is this, that the 8% that got laid off are hired almost immediately by someone else, because a lot of engineers I know, in fact, I barely know any engineers who's out of a job. Once they lose their job, they get picked up really quickly by someone else. So, it's like, and the population.
You're absolutely correct. Now, it might be a familiar name to us as a household as we drive up and down 101 and we see the name of the company on all these big buildings, right? But the people who are laying off could be in another state. They could be in another country too, right? But they could be in another state. It usually is somebody at the lower end level, and the people doing AI, they're the ones that are making the higher pay, especially when we're looking at San Mateo County with their average price point being higher. It's the higher paid jobs that are still there. My point is that the people being laid off, are they engineers? Are they the high earners, right? I mean, when you're looking at those numbers at like 2.6 million average price in San Mateo County, is it the person sweeping the floor, hypothetically, right? Is it the
Right.
person sweeping the floor, or is it the guy that's on the latest technology of AI who's getting the highest pay?
Right.
Who is being laid off? It's that generic floor sweeper, right?
Right.
It's the lower paying job, which when you're talking specifically about Santa Clara and San Mateo counties, it probably won't affect that marketplace as much.
Cool. Yeah, I totally 100% agree with you. So we're knowing all of this, that real estate prices is almost a slam dunk as far as you're going to own a piece of real estate in Silicon Valley. What kind of advice would you have for a first-time buyer in Silicon Valley who really wants to get into this, and it's like, how the hell am I going to afford
I would
this?
say get in touch with Charlie. Charlie will put you in touch with me. Get pre-qualified. Know what you can buy. And I'll tell you another funny story.
Right.
I have people that say, hey, I want to buy a single-family home, and I'm like, I'm sorry, I can only approve you for $1 million or $750,000 or whatever the number is.
Cool.
And they'll go, well, I can only buy a condo for that. And I go, well, where are you living now? Well, I live in an apartment. I'm like, well, isn't that the same thing?
Right.
Except for now you own it, and now you've got appreciation. So when you're comparing what your new housing payment is going to be to where you are now, especially if you're a renter, keep that in mind. Are you comparing an apple to an apple? Is it the same square footage? Does it have a backyard? Is it a connected wall? Yes or no?
Right.
If it's different, of course, the numbers are going to be different too. So be realistic to yourself. But the end of the day, get in as soon as you can. Get that equity working for you so that you can leapfrog. Now, the average person holds on to homes 7 to 10 years, but if you desire that you want to have a single family detached home, maybe you start with the condo PUD. Maybe you have children, but they're brand new, right? They're just out of the package, so to speak. They're not going to school until they hit kindergarten at 5 and 6 years old. So maybe you're in a place where the school district isn't as desirable, but you're still building equity. And hopefully by the time they're ready to go to school, that you can move into a better school district, right? Not that I want to go into child psychology or anything like that, but it's probably the later years where it's more important than the younger years.
You can build equity a lot faster than you can build cash in your bank.
Oh, 100%. I mean, we showed the numbers for San Mateo County, and it went up like what, 400,000. So who is saving 400,000 divided by 12, right? That would be 33,000. Who's saving $33,000 a month? Or we can go ahead and divide that per day. That'd be $1,100 today. It's not like I simply stopped drinking Starbucks and can save $1,100 a day.
And if I remember your numbers correctly, it was based off of a $1.8 million home, and the average home over
in
there.
San Jose area, correct.
And $1.8 million would give you roughly $440,000 in down payment that you would have to pay if you paid for if you bought a house this time last year.
If you wanted to put 20% down,
let me do the math.
True, it would be $360 plus closing costs.
Yeah.
But the minimum down payment at that price point is only $10.
Oh, okay. But assuming you put like 20% down, so you put $360,000 plus closing costs. Let's just put it like just $20,000. So you're down in terms of cash $380,000. But in that first year alone, you built $333,000 $33,000 a month in equity, so roughly around $380,000. So whatever you put in cash, you almost make it back in terms of equity in the first year. Would I be wrong to say that? Is my math right on this?
That was true for San Mateo County. We saw a 7% increase in the greater San Jose area, which was $119,000 in 1 year. But who the heck buys a house and sells it the next?
True.
Right? Who wants to move? It's just a pain in the butt, right?
True, but it's a really good use of capital. Basically, that was my argument.
And the number two thing that everybody forgets about is every time you make a payment on your mortgage, it reduces the balance of
Principal.
that loan.
You have more equity in it. That's right.
And not that we want to give tax advice because neither of us are enrolled agents or CPAs, but there is some tax deductible items called interest on your mortgage loan. And potentially property taxes as well. So if you're a renter and you're making the kind of income that it takes to buy that kind of house, some people go, Dave, I can't afford that payment. Oh my gosh. And I go, well, did you get a refund last year? Did you owe money? Oh, I got a refund. Well, how much did you get? Oh, a couple grand. All right, great. Well, by the time you file your tax returns for the next year, not that I want to give out tax advice, but you're going to have all these write-offs. So maybe you can adjust your W-4 form with your employer and your enrolled agent or CPA's help so that you get more of your check when you actually hit your bank account to afford that payment that's a little bit higher than what you're paying for rent right now. Or even if it's, I already own, but maybe I don't owe a lot on my house and now the new mortgage is going to be bigger or the interest rate's going to be higher, but it's going to provide that tax deduction. So the number one piece of advice, hey, you know what? Stay curious, ask questions. Ask Charlie, ask me, and we'll help break down the numbers. We can tell you what the interest on the loan's going to be so that you can bring that. Hey, we're going into tax time anyway, so you can bring that to your tax professional and say, hey, if my mortgage interest was this, how much more take-home pay would I have?
Cool.
It's just thinking of the whole picture.
Got it. Thank you so much, Dave. I really appreciate your sharing it. It's been really, really fun. It's nice to talk to a numbers guy. I'm a fairly numbers guy myself. One final question, I promise you. It's the last question. If people want to get in touch with you as far as talking numbers with you, how do they get in touch with you?
Well, the number one way would be obviously through you. Just say, hey, Charlie, put me in touch with Dave. But the best way to get a hold of me, hey, I've only got one phone number, so you can text it, you can call it. That phone number is 408 area code 406 1934. And as you can see in the corner, my name is spelled out there. So it's Dave Campagna. Campagna is like lasagna, right? I am an Italiano. And so Dave.Campagna at the name of my company that I work for is Fairway. So it's Dave.Campagna at FairwayMC as in mortgage company.com. So Dave.Campagna at FairwayMC.com is my email address. So either email me or call me. I typically work Monday through Friday till 6 p.m. I'll make special requests to talk to people in the evenings on the weekends, but I generally stop answering my phone at some point in time so I can have a normal life too.
Thank you so much, Dave. Your contact details will also be in the description, in this video. Thank you so much for joining us. Thank you so much if you got this far in the video. Really, really appreciate you for joining us. Again, if there are any questions you want in terms of real estate in Silicon Valley, give me a call, and Dave and I, we're working as a team. We'll help you fight and try and help you a good one. Thanks again for joining us.